Very cool. Well, some great wins to start our days off with, guys. I'm going to give the floor over to our studious guest. This is Mr. Steve Lemmons. You guys have seen him before. He is one of the top rated LOs in the country. Didn't you just get a prestige of being like one of the top 1%?
Yeah, I don't really talk about it much, but yes.
I do. I talk about it all the time because there's three ways of getting, trust, and one of them is conveyance of trust. And now we have not only conveyance of trust with the authority. So it's not only the authority in lending, but also someone I've done a ton of business with. So he called me up yesterday and said, "Hey, Big D, do you mind if I jump on a call with your agents? There has been some mistalk about what's happening in the finance world lately." And I said, "You know what, Steve, that's a great idea, because if I'm talking out my ass, I want to be corrected quickly and by the professionals." So I've invited him on this morning to talk to you guys about what's happening in the financing world, as well as to become better and sharper into this weekend. Sound good? All right.
All right, that sounds good. Good morning, everyone. So who knew that starting in 2023, you guys would learn something called loan level price adjustments, and it would be a conversation that just about every real estate agent is having across the country right now. So I want to dispel some of the rumors. I want to validate some of the rumors and just really clarify how it works, what the changes are, and how it affects buyers. So first off, I want to dispel one major rumor. This is not going to necessarily cost higher credit buyers $40 a month. Not even sure where that payment came from, what that's from, where that's from. So the loan level price adjustments have actually been in place unbeknownst to you, because the media wasn't covering it until about 2 weeks ago. Well, I shouldn't say unbeknownst to you. Some of you may have known that it came out, but there was no communication about it whatsoever. These have been in effect since March 1. So they've been in our pricing. They've been in every piece of financing that we've seen since any deal that pretty much was, locked after the 1st of March. So a couple of things to know. So some of the loan level price adjustments actually went down. Some of them went up. And there's one area that the agencies were really trying to attack. So a little history about loan level price adjustments. How many of you know that how many of you have known that prior to this change, if you put 20% down on a mortgage versus 5% down, the person putting 5% down got better terms than the person putting 20% down? Just kind of show me your hands and your pictures. How many people knew that? So I can see some people, raise their hands. Some were like shaking their head no. So shockingly enough, because of the way the loan level price adjustments used to score from the agencies, anytime you put less than 20% down, the presence of mortgage insurance gave you a better interest rate than somebody who was putting 20% down. Basically telling the buyer putting 20% down, thanks for your 20%, you don't get a benefit because we're not protected by a mortgage insurance company. So the loan level price adjustments changed on the higher end, so of loan to value. So from 95% and above, pretty much across the board, loan level price adjustments went lower. And that is based on the initiative that Fannie Mae and Freddie Mac have, that they want to try to give first-time home buyers the opportunity to buy homes at a cheaper rate than they could in the past. Now, if you could, and I'll send you a little bit of this LLPA breakdown. I actually have a chart on where the LLPAs changed. It got worse and got better. So I'll send it to Dan and he can distribute it to all you guys after this call. But when you see the chart, you're going to notice that everyone's rates above 95% loan to value got slightly better. In other words, they reduced the LLPAs. And I'm going to refer to them as LLPAs now because loan level price adjustments has a lot to say. In our world, we call them LLPAs. Now, one area that was really, and I'm gonna raise my hand, I've been guilty of it plenty of times. that rates actually got worse and the loan level adjustments got worse or higher was primarily between 80%, 80.01% loan to value and 85. So we knew what the loan level price adjustments were doing on our market. I will tell you, there have been numerous times when I've had a buyer and they were going to put 20% down and they were super rate sensitive, but they were going to start paying down their mortgage quickly. I would literally talk through that buyer about putting 19.9% down. So slightly less than 20% down. They got an 8 2/4 low run rate, and their mortgage insurance lasted literally only like 4 or 5 months because they would pay it down below the limit almost immediately. Tricky, right? Well, in our world, it's our job to come up with the solutions to get the cheapest financing for buyers. So we use that to our advantage. Interestingly enough, when the new loan level price adjustments came out, the biggest adjustment to LLPAs was, guess what, loan to value? 80.01% to 90% loan to value. So because they noticed that a lot of these buyers were putting down less money intentionally and then paying down their loan to get better terms. And the problem with that is that they knew we were manipulating the system on it. The system was flawed from day one, and they finally adjusted that. So you will see some slight rate increases in that loan to value range. However, for credit scores that are high, you don't really see much of a change at all. There is a fundamental change in the loan level pricing adjustment chart that occurred that no one wants to speak about. They just want to make it, for lack of a better way of putting it, political. They want to say people with higher credit are paying more now. That is actually not exactly the truth. So what happened in these charts is prior to March, the loan level price adjustments ended at a 740 credit score. So in other words, you have a 740 credit score, you have an 808 credit score, same exact terms, same rates, same everything. And the pricing models for conventional loans go from 620 all the way up to 740. In the new model, they go from 620 to 780. So in other words, they increased the credit score for the top tier. So people with excellent credit used to be 740. Now in the world of mortgages, it's 780. So if you're comparing a 740 credit score prior to March to this, it is about a quarter worse. Not massive. A quarter in points is, on a $300,000 loan, is about $750. Not sure where the $40 in payment came from or where that came out, but it has nothing to do with payment. It has to do with cost of a mortgage. But if you now have a 780 credit score, before you got no benefit, now your rate isn't adjusted like everyone else's would be if they had less than a 780 credit score. Here's the other thing that I want to address, because they make it seem, and this is the political nature of it, buyers now have more access because they did lower some of the loan level price adjustments for lower credit scores. So in other words, if you had a 620 credit score and you were putting 5% down, the old adjuster used to be 3.5% in discount points, a massive fee. Now it's 1.75%, so they cut it in half. What the agencies didn't tell you is that the chances of somebody getting financing at 5% down with a 620 credit score is less than 1%. So just because they changed the pricing does not mean they changed the underwriting model, which is why in our world, to a certain extent, some of that lower credit score, FICO score, LLP adjustment was fluff to make people feel good. Because if somebody has a 625 credit score, they're not going to get through the system on a conventional loan. And more importantly, the terms of that loan are so inferior to an FHA loan. Any loan officer who tried to put them in a conventional loan over an FHA loan should be literally shot. I hate to say it that way, They should be shocked, because here's the reality of it. At 5% down, that rate is probably around 7.5% to 8% with a credit score of 620. Not to mention, the mortgage insurance premium monthly is based off of a factor of 1.4%. If you look at an FHA loan, they'd be at like 6.5%, and the mortgage insurance premium monthly would be based off of a factor of 0.55. What loan officer in their right mind would ever try to sell them a conventional loan over FHA in that scenario? So greater access to financing with lower credit scores is the biggest misnomer that we've seen in these adjustments, because they're making it seem like they've made it easier for buyers to get financing, where in reality, they've made it cheaper, but they haven't made it any easier. So in other words, if you have somebody with a 640 credit score, you're going to get an FHA pre-qualification probably 99% of the time. Now, if that 640 credit score happens to be putting 20, 30, 40% down, that financing has really become a little bit cheaper for them, not versus someone with good credit, but it does give them more access to cheaper credit because of their down payment, because that mitigates the risk of their credit. But by no means has it become easier for them, or they have more access to better rates and terms because of this, because the access starts with being able to be qualified. And the systems are actually dialed in right now. So in other words, credit has tightened a little bit. So it's even harder for somebody with a lower credit score to get approved conventional versus what it was last year. They turned the dial in about October of last year, coming up with all these new rules. Things like bonus income used to be a positive thing. Now they're considered a negative thing in underwriting. So a lot of things have changed in the underwriting guidelines with regard to the automated systems that is unbeknownst to most of the industry, but it is a very real factor in that even though they've reduced some of the loan level price adjustments for credit scores that low, not one person can still get financing. In the last 12 months, to give you an idea, my branch, and I can only use my branch because I can't compare every branch unless I literally had everyone look up their data. In the last 12 months, we've closed 438 loans, of which about 53% of them were conventional and 47% of them are government. Out of those 53%, so that's what? Somewhere around 200 and something loans, somewhere in that range. At less than 10% down and less than a 650 credit score, we did one transaction, conventional. The reason why we went conventional for this particular buyer, I dug into it a little bit, is he was a first-time home buyer, and he also had an income limit that was below $64,000 a year. Why that's important is he becomes then eligible for a loan that is by the agencies called a home ready or a home possible loan. So instead of him having massive rate adjustments, whenever somebody is under the income limits of $81,800 if they're a first-time home buyer, or $64,000 regardless of whether or not they're a first-time home buyer, so there's two different programs, all of the loan level price adjustments are waived. So he was able to get the same rate, and for whatever random reason, out of the 500 others that we've tried with a 642 credit score, he went through the system and got an approved eligible on a DU loan, Fannie Mae, at 5% down with a 642 credit score. I've ran probably 20 this month as a test just to see if they've loosened anything. Not one of them I've been able to go through. It is that complicated for a buyer with low or marginal credit to get a conventional loan putting less than 10% down. It normally starts to approve someone with less than a 660 credit score at probably 15% down, and then at 640 credit score lower, probably 20% down. So it is a massive, massive misnomer to think that these buyers who have lower credit scores now have more access to credit, because in reality, they do not. And that is the biggest thing that we're hearing out there, that, oh, lower credit buyers are going to have more opportunities than higher credit buyers, and higher credit buyers are now paying more money. That is partially true with higher credit buyers because they changed the credit plan from 740 to 780. But if you have a 780 credit score now, which is now considered the top tier, they pay no more than they did before. A 740 will pay slightly more. 720 will pay slightly more, because that is not considered a top tier anymore. The reason why that's important, and you understand it from a global level, does anyone know why the credit agencies changed that? Does anyone have an idea or a thought as to why they would have changed it and made the credit score the higher tier on a higher credit score now? Does anyone know why?
Is anyone awake?
Inflation?
Not so much inflation, Dan. It's very simple. This is a way for the agencies to tighten their credit markets. So if they make it more expensive for borrowers with credit scores that in the past have not performed that well, it now makes their risk they're a little bit more risk adverse. So they're giving a benefit to somebody with a higher credit score, because the agencies, although we're not seeing it in Tucson, there are probably 20 to 30 markets in the United States that are in a declining market right now. We're about 100 miles from one. We're seeing appraisals come back in Phoenix now marked a declining market, which is a whole different can of worms, because then when in a declining market, you can no longer put 5% down. You're required to put 5% down more in a declining market, which is causing a whole wreak of havoc there, because we haven't had to deal with a declining market since 2008 and 2009. So, and by declining market, their market is probably down 20 to 25% year over year. Where Tucson is probably 10 to 15%, the correction really occurred most of last year. So we're not seeing it as much. So it doesn't mean that it can't get here. Tucson has a tendency, I'm going to knock on wood, I hope it doesn't happen, has a tendency to follow Phoenix, but it has not shown any signs of it as of yet, where Phoenix was showing signs, towards like March, April of last year, they were already showing signs of it. So that's very good news for Tucson, as long as, inventory stays manageable, and hopefully we get a little bit more inventory. But in reality, we're not seeing any declining markets right now, but the credit markets are definitely tightening in response to what the Fed is doing. All of these things, as unemployment ticks up, all of those things become more risk adverse to mortgage companies and the agencies themselves, and they try to adjust and accommodate for the risk.
Steve, real quick, you mean number of homes sold when you threw out the last two stats, 20 to 25% there and 10 to 15 here? Number of homes sold or price point?
Price points.
Price point.
Yep, Tucson took about a 13% reduction. I know that you see the numbers on it, but what you got to get is when those numbers actually come out, you look at list price to sell price, and a lot of the reductions in Tucson, Mara, actually occurred because sellers were still living in 2021, and the agents had to basically smack them into reality. Like, dude, you're not going to get $50,000 above your list price on your home. You're going to be lucky if you get list price right now. And, that was probably May through October of last year where we saw the most attrition in our market. It was about 12% overall, but the first 6 months of the year, we saw an increase. So it didn't show like it was that significant, but in reality, Tucson did take about a 10 to 15% price cut from May to October of last year. Now it's kind of stabilized again, mainly due to inventory issues. It seems like a lot of homes are on the market under 400 grand, which is great for our market, but that is also considered an affordable market with a $2,000 mortgage payment now. So you're seeing a lot of competition in those areas where you're seeing, multiple offers. I heard somebody say escalation clauses, all of those things. So that's definitely occurring in Tucson, especially under 400 grand. But in Phoenix, it is not. You get a $550,000 home out there, you may have one offer and the home may sit 40, 50, 60 days. So different market out there for sure right now. Any questions at all on any of this, guys?
Any questions at all, about the market? We're sitting in front of someone, like you said, who's 450 some loans last year, and he's plugged into every major market, as well as some of the biggest names in Tucson, knowing what's happening out there. So use up his time. He's actually given us more than I told him. I said like 5 or 10 minutes. Thank you, Steve, for investing more in us.
Absolutely.
By a show of head nods, was this worth your time? Did you learn something? Guys, we'll ask our friends to come back and provide value and information to you directly. But I want you to use these opportunities to ask questions, get clarity. So does anyone have any questions that Steve can answer that's pertaining to any kind of financing beyond the scope of the price changes or the changes in financing structures or the different buckets that we can fish in?
Dan, Steve, thank you so much for being here. I feel like I was just hit with a ton of knowledge, and I don't have any questions at the time, but I really appreciate all of this.
Yeah, to tell the story, there was a time before all of Big Dan's world that I would go to the Williams Center and sit in front across from Steve and have impromptu meetings about the market and what's happening and ask stupid questions like, how do you qualify for FHA loans? What is a VA? What do they mean by government loans? Right? These are all things that I remember sitting in front of him and getting this information, and then years later building these relationships to where they're at. So you guys, if you have the opportunity to get some clarity, ask it, get some information. I know that Jacob definitely likes working with Steve as well as I do. He's one of our top rated referral partners out there, but also a good friend of mine. So if you need questions or if you have any information that you're looking for or any doubt, or if something's going wrong in another loan and you want to just to bounce it off of him, he's a really good resource. And I hope that you guys all put him in your stack of lenders, because having that depth of knowledge is not a bad thing in your business.
We've been bouncing a lot of things this week.
Oh, yeah.
Oh, yeah.
Which I will be calling you today about one more. So
I'm sure you've got some extra stuff, Michael. You've got some extra things going on right now for sure.
Yeah, absolutely. So thank you, Steve. Really appreciate it.
You're very welcome. And one quick note, I forgot to mention this. So it's interesting that we have these LLP adjustments on conforming loans or conventional loans. One thing to also note, what was very interesting on it is we almost seem like there's a little ebb and flow in the market. FHA and VA loans actually became cheaper in the last 2 months, which is why you're probably seeing more FHA pre-quals out there, because they reduced the mortgage insurance premium on FHA loans by 30 basis points. And they also reduced the funding fees on VA loans. So those loans have actually become cheaper, where some of your conventional loans have become more expensive. So it's a natural ebb and flow. Where the last couple of years have been primarily conventional, we're definitely seeing more and more government loans coming back. So get versed on your FHA and VA loans. We're seeing more and more of them in the market every single day.
And we'll have a whole nother class on that one, because I think it's important for you guys to understand when you're being the buyer's agent out there looking at houses for FHA, VA, what the different structural needs of the property should be, as well as a listing agent, so you can help guard your clients against those unforeseen changes. Simple stuff like peeling paint may not seem like a very big issue. However, FHA and VA do have issues with them. So everyone say thank you to Mr. Lemmons.
Thanks everyone for having me.
Steve.
Thank you, Steve.
Thank you, Steve.
I'm going to put Steve's cell phone number in the chat. So if you guys need it, please take it down.
Yeah, if you guys have any market questions, things about what the market's doing, the economy of the market, we had an agent just ask for a whole snapshot of the market, unemployment rates, inflation rates in Tucson, all of those things. We have access to all that information. It's very good for your clients to know these kind of things, especially to dispel the myth of the market's going to crash. Because I don't even see the market crashing. Do I think this is a temporary uptick? Yes, I do. But I don't think the market's going to crash. I think it's going to be a very stable market. And I do think that inventory, as the credit markets crunch a little bit on it, you're going to see inventory increase a little bit. I still don't know if we're going to get to a healthy level, But if you guys have questions on the market, feel free to reach out to me, and we'll go through any questions that you have for your clients.
Awesome, guys. Hell of a Friday. Remember, we were red on Fridays, and now you can see why. Steve, he wants to show you his red on Friday shirt, Red Nation.
Yes. Remember, everyone deployed.
Yep. Something Fairway started many, many, many years ago that we just kind of jumped in on. That's one of the reasons I wear red on Friday. Jason wears red on Fridays. So I want to say thank you.
We wear purple now.
Purple on Tuesdays, baby. Purple shirt Tuesdays. Hey, you guys thought I was
Purple
crazy.
Shirt Tuesdays.
We should put a cause around it. We really should. So, just a bunch of arrogance. Steve, thank you again for all your insight knowledge. We do appreciate your relationship and your partnership. Everyone else, thank you so much for being a part of this, guys. And I hope you have a fantastic Friday. Go out there and change somebody's life, okay? It's time to get to work. Till then, high five.